My name is Chi Wu, and I'm a senior attorney at the National Consumer Law Center. My area of expertise is credit reporting, credit scores, and other types of what we call consumer reporting, which, basically information reports about people used for things like credit granting, employment, screening for renters or insurance. So the American credit reporting system is an interesting creature. It is often touted as something beneficial and great and, part of the advantage in the United States, but it has a lot of downsides. So the way credit reporting works is in the United States, there are three private companies. They're called Equifax, Experian, and TransUnion. They are not government agencies. They are private for-profit entities. So their number one goal is to make money for their shareholders. It's not for the public good. It's not to help consumers. It's not even to help the creditors. It's to make money. They constitute what we call an oligopoly, which is a technical economic term when an entire industry only has a few actors. But it's worse than that because some oligopolies, if you have three players, like three cell phone companies, you can pick between the three. But with credit reporting, you cannot pick between the three. If you want a mortgage in the United States to buy a house, if you want a credit card, if you want an auto loan to buy an automobile, you have to deal with all three. So you're basically captive to these companies. And they know that, which is why they don't treat consumers very well. Okay, so let's talk about how it works. These three companies collect information on consumers. Their main source of information is lenders and debt collectors. So what happens is that lenders, banks, other types of creditors feed information on a monthly basis to the credit bureaus. And what they send to the credit bureaus is information about your loan. So let's say you have a credit card, when that credit card was open, what the credit limit is, and what your payment is every month, whether you're paying on time or not. If you miss a payment, it shows up in the history of that credit card account. And then if you default, which means you just stop paying, that also shows up. Same thing happens with mortgages, auto loans. So that's probably the biggest set of information that the credit bureaus get. The other set of information is from debt collectors. So let's say you owe someone money and that person hires a third-party debt collector or sells the debt to a debt buyer. The debt collector or debt buyer then reports that debt to the credit bureaus. So if you look at a credit report, there are different sections. The first section is just your demographic information, name, address, date of birth, and what's called a social security number. So in the United States, a lot of people have the same name. I have a fairly unique name, Chi Wu, but there's a lot of John Smiths or Mary Nelsons. I don't know what it's like in Japan, but in the United States, a lot of common names. And so the only unique identifier in the United States is the Social Security number. It's a number issued by the Social Security Administration, which administers old age benefits in the United States. And even though it wasn't meant to be a national identifier, it has kind of turned into that. So that's on your credit report. Also, and that number is very important. And I'll talk a little bit about some of the problems with credit bureaus and how they use that number. Okay, so that's the demographic information, employer, addresses, cell phone numbers. Then you have where all the accounts are. So these are all the credit accounts or debt collection accounts. So all your credit cards, your mortgages, your student loans. In the United States, unfortunately, if you go to college, you often end up borrowing money to pay for the high tuition rates. Unfortunately, the United States does not have affordable college education, so a lot of students end up with student loans, so they'll show up on credit reports. And then there's also a section for what are called inquiries. So when you apply for credit or insurance and a business obtains or orders or pulls your credit report, we call it a pull, that also shows up on the credit report. And then if you've ever filed for bankruptcy, that shows up on the credit report. So I don't know if your viewers would be familiar with the concept of bankruptcy. They would be? Okay. So that's the information in a credit report. And that information then is often used for things, it's used for underwriting or granting credit. It's also used by about half of employers. It's used by 90% of landlords. So even if you don't want to buy a house, you just want to rent an apartment, most landlords will look at your credit report. It's used by insurance companies. And we actually think that it's not great that employers and insurance companies and landlords use credit reports. When creditors use the credit report, they often use what's called a credit score. So what happened is this company called Fair Isaac or FICO developed a computer model. And that computer model takes the information in the credit report and it runs it through this computer model or algorithm, and it spits out a number. And that's a credit score. And a lot of creditors just look at the credit score. The credit score is based on a few different factors. So obviously one is payment history. If you miss a payment, that hurts your credit score. If you default, that hurts your credit score. If you have a debt collection item, that hurts your credit score. But that's not the only factor. The credit score also looks at the ratio of credit that you've been granted versus the amount you've used. And this is mostly a factor that depends on credit cards. So let's say I have a credit card with a $1,000 limit. It means I can charge $1,000 to that card. If I charge only $200, that's considered good. If I charge $950 or $1,000 and max out that credit limit, that hurts my credit score. There's some other factors like how old is your oldest account. The older the account, the better. And whether you have a good mix of credit, like whether you have a mortgage plus an auto loan plus a credit card, or whether you only have credit cards. Someone with a better mix gets a higher score. And then remember those inquiries I told you about, a record of who has obtained the credit score? Those also are factored, because what FICO thinks is if you try to apply for a lot of new credit, it might be a sign of financial distress, and so your score gets lowered. So that's your credit score. So, a lot of people in the United States, especially in the credit industry, say it's a wonderful system because it's very quick. You can get credit quickly. A credit card you can get in a matter of minutes as long as you have a good credit score, a high credit score. They don't even look at the rest of the report. Mortgages maybe take a little bit longer, but because all the information is automated, it can be fed through certain computer models by these quasi-government agencies that kind of control the mortgage market, called Fannie Mae and Freddie Mac. So those are the benefits, but there are downsides. So remember I said this is an oligopoly. So the credit bureaus are not very responsive to consumer complaints. There are a lot of errors in credit reports. The Federal Trade Commission, which is a United States government agency, did a big study back in 2012, and looked at credit reports of 1,000 people. And then these consumers looked at the reports, reviewed them, and disputed errors. And so what the study found is 20% of consumers had a verified error in their credit report. So it wasn't just they said they had an error, they disputed that error and the error got fixed. Okay, so that's 1 in 5 consumers. And 1 in 20 consumers had an error that was so serious they'd either be denied credit or they'd have to pay more for it. Just as an aside, the way credit works in the United States sometimes is you don't get denied credit if you have a not great score. You get a higher price for the credit instead. You have to pay more for it. So these consumers would have had to pay more because there was an error or mistake that affected their credit score badly. Now, 1 in 20 consumers, that's 5%. And you might think, okay, 95%, that's not so bad. But it's actually really bad because credit reports basically act as the financial report card for consumers. Remember, not only are they the gatekeeper for a credit card or buying a house or getting a car, which in the United States, you need a car. It's unfortunate, but there's very few places you can get away without having a car. So it's a gatekeeper. And for something so important, a 5% serious error rate is a big problem. Because if you think about it, if 1 in 5 cars just blew up spontaneously, 1 in 20 cars blew up spontaneously, or 1 in 20 airplanes fell out of the sky, we would not accept that. That would be a big problem. And a 5% error rate is a big problem in the United States. That translates into 10 million, more than 10 million consumers. So there are a lot of errors. What are some of these errors? Okay, one of the ones that just drives me nuts because it's the fault of the credit bureaus is what's called a mixed file. So what happens is one of the credit bureaus, remember that social security number I told you about? That it's a 9-digit number. It's the only unique identifier in the United States for consumers. And you would think that the credit bureaus, when they accept information from a creditor or debt collector, would match that information to a consumer's file using all 9 digits of the social security number, right? No, they don't. They use 7 out of 9 digits to do matching. 7 out of 9. So they use 7 out of 9 digits plus partial name matches. So they don't match your entire name because they can match based on first name or similar names. And they do that because some people change their last name in the United States, especially women when they get married. They will do a partial address match. So what does this mean? It means sometimes they mix up 2 people if their identifiers are close enough, if their names and addresses, and especially the social security numbers are close enough. And we see this happen especially with family members. So because social security numbers are often distributed based on geography and time period. So if you have a brother, sister close in age, and they have similar names, an infamous case was, Dennis Martin and Denise Martin with similar social security numbers, they got mixed up. Often happens with fathers and sons, because in the United States, there's this habit where fathers will name their sons their same name, but junior. So it'll be John Smith and John Smith Jr. And if their social security numbers are similar, and obviously they live at the same address, they will get mixed up. Those are called mixed files. They're completely the fault of the credit bureaus. So those are one of the biggest type of errors. Another type of error is the wrong amount of a debt. This happens often with debt collectors because they will claim that the consumer owes $1,000 and the consumer will say, no, I paid that business through, $700 already. I still only owe them $300. Or they'll just get the wrong person because they don't always have that social security number. And by the way, to give you an example of the dysfunction of the American credit reporting system, until a few years ago, over half of the debt collection items on credit reports, over half, were for medical debt, medical bills. Now, you could have a whole hour on what's wrong with the American healthcare system and how it really harms consumers with medical bills. But one of the harms is it shows up on their credit reports. And when it shows up on the credit report, it means they have trouble getting not only a credit card or a car loan, but sometimes an apartment or a job. And that just seems wrong. Now, in the last few years, there have been some reforms. Paid medical debt is no longer reported, and then medical debt under $500 is not reported. But that still leaves unpaid medical debt over $500, and those are consumers who are sicker and have less income. So, one huge problem with the American credit reporting system is the amount of errors or mistakes. And the credit bureaus do a terrible job of fixing them. So credit reporting in the United States is governed by a law called the Fair Credit Reporting Act. And it provides for a bunch of procedural rights. The consumer has a right to get their own credit report. The consumer has a right to get a notice of a credit report is used against them to deny them something. And it requires the credit bureaus to have procedures to maximize accuracy. And if there are errors, consumers have the right to dispute them. And the credit bureau is required to investigate the dispute. And in investigating the dispute, they're supposed to involve the creditor or the debt collector that supplied the information. Now, when I say investigation, most people think this involves a fair amount of scrutiny. You look at documents. Maybe you call the creditor. The consumer says, my mortgage company is reporting that I was late with my payment last month. I was not late. Here is a bank statement showing that they debited my account. And you would think that the credit bureau would look at that document, maybe call the creditor. No, none of that happens. Instead, they take that dispute and they scan it and upload it and send a 2-digit code to the creditor, or 2 or 3 digit. They basically say the digit translates into claims never paid late. And then the mortgage company is supposed to do an investigation. Now, sometimes they'll do an okay investigation, but sometimes they will also engage in a very, very perfunctory, shallow investigation by just looking at their computer records, which generated the mistake in the first place. So maybe their computer records still show that payment is late because somebody screwed up with recording the payment, or there was a glitch. They just look at their computer records, and if the computer records show it's late, they'll say, "Oh yeah, it's late. We verify that late entry." And whatever the creditor or debt collector responds, the credit bureau will accept that. In other words, the credit bureau basically is like a judge who always rules for the defendant, or a referee that always rules for the home team. They always rule for the creditor or debt collector. And debt collection is one of the biggest sources of complaints, because sometimes they get the wrong person or the wrong amount. So remember I told you medical debts are a big source of debt collection items? Let's say I go to the doctor and I get a $600 bill, but I say, "No, I don't owe you $600. I paid a $75 copay. So I'm not gonna pay that until we straighten this out." In the meantime, the healthcare provider sends that bill to a debt collector and it ends up on the credit report as $600. Or maybe I'll say, I had insurance and the insurance was supposed to pay for that. And you're not supposed to bill me the whole amount under your contract with the insurance company. Doesn't matter. Credit bureau will always take the side of the debt collector. Yeah. It's a very dysfunctional system. And they do that because, remember, consumers are captives and they are not the customer of the credit bureau. The customers of the credit bureaus are the creditors and the debt collectors. We are not the customer. Our data is the commodity that the credit bureaus trade in. And so that's why they don't treat consumers very well, because we have no choice. And when you don't have a choice, obviously you have a market failure. Now, things have gotten a little better because in 2011, we got the Consumer Financial Protection Bureau, which is allowed to supervise and enforce the law against the credit bureaus. Even then, it's still pretty bad. This Consumer Financial Protection Bureau takes complaints from consumers. Number one complaint is against the credit bureaus, number one complaint. And there's like hundreds of thousands of complaints every year. It's like, at this point, I think it's 70% of their complaints are against the credit bureaus. And you're talking 500,000, 700,000 complaints a year, which makes sense. Remember, 10 million people have serious errors on their credit report. So, that part is bad enough, right? The errors, the not treating consumers well, the not disputing mistakes and fixing them, that is bad enough. But it gets worse. So even if they did everything correctly, there's still a problem with the credit reporting system. Still several problems. So one of them is that, in the United States, one of the biggest issues, of course, is race and racism and how different groups are treated. And if you look at credit scores, Black consumers and Latino consumers have lower credit scores. So do low-income consumers. And it's not because they're not responsible. It's because of the racial wealth gap and a historical legacy of discrimination. So the racial wealth gap, I don't know if you're familiar with it. In the United States, if you look at, so there's disparities in income between Blacks, whites, and Latinos. And that's bad enough. But the hugest disparity is in wealth. So an average white family household will have over $100,000 in wealth. The average Black family will have like $8,000. So the disparities in wealth are much greater. And that is everything to do with the historical legacy of discrimination. It has to do with the fact that Black people could not buy homes in certain neighborhoods, wealthier neighborhoods, better neighborhoods. So that's called segregation, residential segregation. And they didn't have access to affordable credit to buy homes. That's called redlining. They're discriminated against in employment. The criminal justice system targets Black and Latino consumers. All of those factors mean the families have less wealth and the community has less wealth, because often what helps, if you have a family that gets into financial distress, often it's wealth that allows them to weather that financial distress, to get past it, right? If you have $100,000 in assets, it's easier to survive a period of unemployment, let's say during COVID, than 8,000. And it's not just your own family's wealth, but sort of the network. So if my sister's family is in financial trouble, I can lend them money. But with the Black community, their economic circumstances is everybody has a very tight budget, right? And that has everything to do with historical and present day discrimination. And so that is reflected in credit scores. And I often like to say, if you looked at credit scores as a measurement, as a research tool, they reflect very well the historical and present day discrimination against certain minority groups in the United States. But they're not just a measurement tool, they're a gatekeeping tool. And so they perpetuate and reinforce existing and historical inequality. So it's harder for Black consumers to get affordable credit and buy houses. So that's why Black consumers, the home ownership rate is not only lower, but will always be lower. It's a vicious cycle. And it's a vicious cycle in general. I mean, for consumers in general, if you hit a period of financial distress and it shows up in your credit report, then you are foreclosed from good economic opportunities for at least 7 years, right? Because that's how long information stays on a credit report, 7 years. So let's say you lost your job during COVID, you missed a bunch of bills. Now it's harder for you to get a job, get an apartment, get affordable credit, get a small business loan to open up your own business. So it reinforces, it's a vicious cycle, and it keeps people down once they get into trouble, they stay in trouble, or the after effects just keep showing up. So it reinforces inequality. The United States has this huge problem with inequality, and the rest of the world does too. But in the United States, it's worse because of our American credit reporting system.
Oh, thank you. What I was wondering is like, if you to advise Japanese people, would it be like have better car or don't have it at all? Well, let me start from the second point then. I wonder if we create an algorithm to prevent this vicious cycle. I don't know how, but probably by setting the time like shorter, so that you can recover, or not to take into account that much about wealth.
Yeah.
Yeah.
There are ways to address this. So definitely we have urged that the credit scoring algorithms be re-engineered to reduce racial disparities. There are ways of doing it, which, I mean, I'm a lawyer, I'm not a data scientist, but I read things where data scientists have said, here is how you try to reduce racial disparities using an algorithm. And it is possible. You're never going to get rid of them, but it is possible. There's also different types of data you can use. So there's a lot of effort to try to find alternatives, what they call alternative data. And some of the efforts, I think, can be harmful to consumers. Like, there's an effort to get rent payments onto the credit reports because for the most part, rent payments are not reported to the credit bureaus. And it could help a little bit if it's all positive. But what we really worry about is if negative rent payment information, like a missed rent payment, is on a credit report, then when that person goes to rent a new apartment, they won't be able to get a new apartment, and literally they become homeless because no landlord will accept them. So we have to be really careful in thinking about solutions that the cure is not worse than the disease. That being said, one positive or one promising alternative to credit bureaus is what's called cash flow or bank account transaction data. That is the ability to tap into a bank account and see how a consumer is spending their money, look at the inflows and the outflows. And if someone is able to stay in the positive and have a cushion in their bank account, that usually means they're a good credit risk. And that is, I think, a better indication of someone's behavior with respect to repayment than a credit history, because the credit history can be affected by things outside of consumers' control. They get sick, they lose their job, they're in an accident, family emergency. But if you look at maybe just the last 6 months or year of a consumer's bank account history, you can get a better idea of how they actually manage money. And you don't have to go that far back. So yes, definitely you have a good point. The American Credit Reporting Law, the Fair Credit Reporting Act, allows negative information to be reported for 7 years. And we think that's too long. Those time periods should be reduced to like 3 years maybe.
Mm.
Because frankly, after that amount of time, the information really isn't all that relevant.
Mm.
But um, even then, bank account transaction data is, I think, should be the future of how you measure willingness to repay, which is the
Mm.
factor that credit reports are supposed to measure.
I see.
I want to be clear. I'm not advocating for just getting rid of
Mm.
these, uh, getting rid of credit reporting or credit scoring, or going back to when credit was granted based upon subjective factors, because that's even
Mm.
worse.
Mm.
You know,
Oh.
scoring
Oh.
is an improvement,
Mm-mm.
but it's still incredibly flawed. And we need to, the English American expression is build a better mousetrap. I know this series is about artificial intelligence, so
Mm.
I just wanted to say,
Mm.
artificial intelligence is a tool, and it could be helpful or it could be harmful when you're talking about models for credit scoring or models for credit granting, because the thing we know about, and usually when we talk about AI, we're talking about machine learning, because like AI covers so much, and some of what AI is really isn't anything new or special,
Mm.
but machine learning is what's new. The, the,
Mm.
the ability of the machine to decide what factors to use and to evolve.
Mm.
And the thing about machine learning is it can be harmful, because what it often does is, if you give it a training set of data and you tell the machine what the goal is, and you don't tell them to be careful of things like racial or gender, other disparities,
Mm.
what it spits out is
Mm.
not only going to have racial or gender disparities, but it's going to supercharge them.
Mm.
It's going to learn the existing system is racist and sexist, and so that's what it should do. So, but you can program the machine intentionally to say one of your goals is to reduce racial, gender, and other disparities. And so that is what we hope will be one component of reforming the credit reporting system.
Thank you. It was very great clarification and clarified many things. Thank you. And so then why you already explained that, because it's based on it's commercial private um, institutes or companies who are in charge, and oligopoly, or
Mm-hmm.
but in fact it's monopoly. So is that why they don't adopt, they don't make changes and leave those errors intact?
Yeah, I mean, the reason why these three companies don't treat consumers very well is because they're a functional monopoly.
Mm.
And the fact that they're a functional monopoly can also be seen by the fact that they have very old computer systems.
Oh.
So, um, if you remember, 2017, the company Equifax, which is
Mm.
one of the credit bureaus,
Mm.
was the subject of a data breach where hackers stole information about 140 million consumers. The computer system that was hacked was from 1970. 1970. So it was being held together by two guys who, if they had died or retired, like nobody would be able to fix their system. So part of the problem was their like old systems were so old that they became vulnerable. Now, Equifax at least has invested a lot of money in upgrading their computer systems because they got hacked. But Experian and TransUnion, and then the systems the three of them share, are still fairly old. The system that processes consumer disputes, it's called eOscar, was built in 1993. Yeah.
It's quite old. But
And and to be fair, a lot of the biggest banks are very similar. They have a lot of legacy computer systems, which is why lack of competition, you
mm,
can see it in when you have old computer systems, because they don't have the pressure from competition to keep upgrading their systems and making them better.
So, it's competition issue. If that's to that extent that their system is so bad and dysfunctional, should be great space for new entrants.
You know, yes, you would think there's space for new entrants, but and we're hoping that bank account transaction data, that some of the companies that deal with that data will provide competition. But, you know, legacy systems and inertia are also a powerful force. I mean, even when a big bank moves from FICO like 5 to FICO 8, so one version of FICO to another, they have to do so much in terms of re-engineering their systems and doing testing on their portfolio. So they're very loath to change. Getting them to change is always a struggle. It's really bizarre. You know, the American credit system is touted as best in the world or best in class, but it really actively causes harm to a lot of people, and the credit reporting system does too. You know, if Japan was able to create a better way of analyzing the same factor that credit scores are supposed to analyze, which is willingness to repay, that definitely could serve as a good model. I would encourage the government to do it, because with government you have a little bit more checks and controls in terms of the political system. In fact, one of the reforms we've called for is to have a public option credit bureau, that the government would be one of the credit bureaus, so that you would have one option that was more fair to consumers. And it's funny. A lot of people think credit reporting is already run by the government, but it's not. It's not even run by nonprofits. Run by corporations.
May I ask you your view on Chinese credit social scoring system?
Well, I'm not as familiar with the Chinese social credits or the social score. I know it goes way beyond financial information to things like behavior and whether you jaywalk or such. I would say I have read only a couple articles, and it may have the same issue that the American credit scoring system does, in that if you mess up, it keeps you from being able to recover. It forecloses any possibility of second chances. You know, when people are young, they mess up in their youth, right? And if you say, okay, you mess up in your youth, you never get to recover, you have a bad score, that follows you forever. You have now foreclosed any possibility that as that person gets older and wiser, that they're able to become a productive member of society.
It's sad to see that the US is no longer the dream comes true country.
Yeah, I mean, there are so many areas where the US is now behind in terms of, our healthcare, inequality, and the credit reporting system kind of reflects some of that. It shows some symptoms of the underlying dysfunction in the United States.
Well, and someone says that the AI or those systems cannot be better than real human beings or society, because it reflects on, make it worse.
Yeah, it just depends on how it gets what instructions it's given. Like AI systems, you always have to give it an instruction, a prompt. And if you're intentional about giving it a prompt that makes things better, lessens inequality,
うん、
than it could have promised.
うん、
And remember, in the United States, the inequality by race and by gender was intentionally engineered for centuries. So telling an AI system to reduce that inequality isn't wrong. You know, it's a good way of redressing past injustice.